Hey there, it's Phil with Warren Street. First and foremost, I'd like to wish you a Happy New Year. I am filming this recording to accompany the 2026 market outlook that's going to be posted on the company blog and is also going out in the quarterly client newsletter. Our director of sales and marketing, Jennifer, has actually given me a time limit for this, so I'm going to do my best to try to keep it high level. If you have any questions or want to explore the nitty gritty, definitely feel free to check the blog yourself or let us know if you have any specific questions. With that said, we wanted our clients and readers to focus on three key themes for this outlook. Number one being AI and its bubbliness. Number two being the state of the US economy. And number three, we wanted to talk about one risk we see to asset markets in 2026. Before I dive into those three themes, I actually want to give a really quick recap of 2025. Heading into 2025, there was a level of skepticism around the benefits of diversification, specifically diversifying into things like international equities or even other asset class segments such as commodities or even in some cases gold. There was reason for that skepticism, though. To demonstrate, we have in front of us the what we call the periodic table of asset class returns. This basically shows a number of different asset classes represented by the varying colors, followed by their corresponding returns ranked from top to bottom for each of these calendar years up here. There's a lot going on this table, but I want you to focus on just one thing. Within the top three asset classes for each of these calendar years is going to be a US large cap equity segment, whether it's US large cap value stocks in the light blue, US large cap growth stocks in the gray, or S&P 500 in the darker blue. And this is going to be US large cap stocks more broadly. It's the broad-based market cap weighted index most of us are familiar with. The fact that at least one of these show up in the top three for over the past decade or so really goes to show just how dominant US large cap equities have been. And, they really just beat out on a lot of other asset classes, whether it's international stocks or gold, pretty much year after year, with the exception of 2025. Last year was a year that narrative got flipped on its head. You had equities from developing markets or emerging markets such as Vietnam, India, South Korea outpacing its US counterparts. Same thing with international stocks more broadly. And even if you look at individual regions such as Europe, represented by this EFI stock label, that also outperformed domestic equities. Gold was most striking. You had gold outshining the S&P 500 by over 45%. It really goes to show that in a year where you had US tariff policy uncertainty, US dollar weakness, concerns around US debt sustainability, holding asset classes other than US stocks did help you weather that storm. Ultimately, I'd say we left 2025 in a more fragmented world where entire economy and nations are now prioritizing things like national security and, in some cases, isolationist policy over globalization. In this new world order where you have a desynchronized global economy, I'd argue that diversification is more important than ever. So that's going to be one of the key takeaways for 2025. We're now going to jump into our first takeaway for 2026, or first theme, being AI. By one measure, AI companies in the S&P 500 accounted for 60% of the S&P 500's increase in value. Couple that with just the sheer amount of spending that's going towards this AI build out. You have approximately $250 billion from the AI titans such as Amazon, Microsoft, Alphabet, et cetera, these hyperscalers. And that spend is also, however, bolstering the US economy. This chart on the left here shows us the percent contribution to real GDP growth or real economic productivity growth from sectors such as information processing equipment, i.e., AI infrastructure, data centers, etc. For 2025, we don't have the full year's worth of data for 2025 yet, but for the first half of 2025, you'll notice that AI spend more or less kept the economy afloat. That's really powerful from AI. It just goes to show that the amount of attention AI has gotten is warranted and deserved. The question now becomes, has the enthusiasm for the AI space gotten excessive? And if so, has that enthusiasm made its way into stock prices? We touched on the is AI a bubble question in a deep dive piece that's going to be published on the blog, and it's also linked in the 2026 Outlook piece itself. But I'm going to summarize the bull and the bear case. Proponents for the AI investing landscape now argue that, hey, this time is different because these big spenders on AI aren't the fragile startups that you saw during the dot-com era. These are profitable cash printing machines with robust business models. In many cases, these are companies that invented their own industries, whether it's social networking or the search engine, and they're using their cash reserves to finance a lot of the spend. And at the same time, because of the earnings powers of these companies, they have reasonable valuations relative to achievable growth estimates. At one point, you saw Nvidia last year having grown its earnings faster than it grew its stock price. Obviously, that's backwards looking information on a go forward basis. It remains to be seen just how attainable future earnings estimates are going to be, but that is what proponents are arguing. They also argue that the underlying demand for infrastructure, particularly data centers, is stronger than in past speculative manias, whether it was the fiber optic build out of the 2000s or even the railroad boom from over a century ago. The bear case, however, is just as loud. A lot of bears remain skeptical, especially around the gap between the amount of spend and the revenue currently being generated. That gap is still wider than even in past bubbles. A lot of the current revenue announcements, even today, are these circular agreements between, for example, Nvidia agreeing to invest in OpenAI and then OpenAI saying, hey, I'll go ahead and buy chips back from you on a go-forward basis. But it's not real external consumer business demand for end AI applications. We don't know what revenue is going to look like yet, and we don't know if revenue is going to come from those end uses such that it justifies all this spend. That question still remains uncertain. We also touch on things like aggressive chip accounting methods or debt financing now being used on the AI build out in the deep dive. But ultimately, the whole AI dilemma is just a big collection of what ifs. I promise you we're not trying to cop out of the question, is AI a bubble? But personally, I think fixating on the bubble label is a bit of a fool's errand. Even if you correctly call that there are excesses in the market today, how do you know when the bubble is going to burst? Is it this year? Is it 3 or 5 years from now? What happens if you sell early just to miss out on gains from a real transformative technology? Peter Lynch has this quote here that says, far more money has been lost by investors preparing for corrections than has been lost in corrections themselves. Food for thought. Our recommendation for navigating the AI landscape is as follows. Number one, keep a seat at the table in which AI plays. This is a real powerful technology that is going to change the world. Chances are you want some exposure to it, but understand how concentrated you are to that space. And then diversify your sources of risk and return accordingly. Own things like international stocks. Own lesser correlated assets like bonds and gold, pending your risk tolerance. Really, we want to balance that concentrated risk with varied sources and returns. That's how we recommend navigating the AI landscape for 2026. Moving on to our second theme, the US economy. Objectively speaking, the US economy is healthy. Productivity is still growing with a very healthy print or GDP print that was most recently released. We also have very robust forecasts for 2026 GDP across many major institutions, fueled by AI adoption, fueled by further AI productivity and spend. Consumer spending, which drives a majority of our GDP as well, remains strong. Despite waning consumer sentiment and concerns around job security, you still have really healthy retail sales numbers and credit card balances continue to rise. Take both those facts about a productive economy and consumer spending continue to remain strong. There's also going to be stimulus making its way with the one big beautiful bill and tax cuts / tax refunds. On top of that, the central bank is currently projected to cut interest rates twice this year, which is anticipated to lower borrowing costs. That is all going to result in more liquidity within our economy and more money in the consumer's pockets. We believe all of that serves as a favorable backdrop for stocks and bonds in the year ahead. It's not all sunshine and rainbows, though. We do have one chief risk we're paying attention to, which is inflation. To give a quick recap, here is a measure called the Personal Consumption Expenditures Price Index. It's the year-over-year change or yearly change. I'm not going to go into too much detail about what that is, but think about it as the central bank's preferred measure of inflation. And you'll notice that inflation hovered around the 2% range prior to the pandemic, but afterwards it shot up. And ever since then, it's been hard to get it to pre-pandemic levels. We believe that inflation is likely to remain sticky, and there could even be catalysts that cause inflation to go higher this year, with catalyst number one potentially being tariff policy. Last year, a lot of businesses and importers seemingly absorbed the impact of those price hikes, but now we're starting to see those price increases make their way to consumers in the most recent inflation prints. If that continues to happen in 2026, we could see an increase in inflation. Stimulus as well, right? This could bolster the economy, but it also means it's more money in consumers' pockets that could be spent, and that could cause the economy to run hotter. Last time this happened, we had stimulus checks, and that did certainly contribute to the demand side of the inflation equation. Lastly, you also have financial repression risk, which is the idea that the administration, in conjunction with the central bank, is willing to tolerate a higher level of inflation to inflate away our debt in order to manage it. And that raises a myriad of questions ranging from central bank independence and credibility, but it's just something really difficult to wrap your head around, right? Like, how do you even think about what the impact inflation will be from that type of an approach? All in all, the last time I remember inflation spiking, we had to raise interest rates. And when we raised interest rates, stocks and bonds were down double digits. I don't think we're going to see as monumental of a shift this time around. Obviously, don't have a crystal ball, but if I had to park this in a camp, I'd park it in the low probability, high impact camp. To hedge against this type of risk, though, we recommend holding things like gold, commodities, or natural resources. If you hold the diversifier sleeve with us, this is something you will naturally hold. That's going to be it for 2026 outlook. I do, however, want to leave everyone with some guiding principles. Guiding principle number one, make sure your portfolio is adequately diversified. Understand where your most concentrated positions / exposures are, and make sure you're balancing that by diversifying sources of risk and return, whether that's to international equities or other lesser correlated asset classes. Number two, make sure your portfolio is aligned with your risk tolerances, right? Your ability to take risk, which is your financial objectives, your long-term goals, or your upcoming liquidity needs, and your willingness to take risks, right? What is your innate response to volatility? Your portfolio and asset allocation construct should match that innate human response and be built to cater around it. Also, don't be scared to rebalance into weakness should there be somewhat of a pullback. If we see something like a profit-taking correction or a market drawdown, don't be scared to lean into the pain and let go of the joy. Doing so will only help you capture long-term growth at more advantageous price points, right? And that is only conducive for long-term capital appreciation. That's gonna be it. That's gonna be it for our 2026 outlook. Thank you for watching. Thank you for listening. Let us know if there are any questions, and I hope you have a wonderful rest of your year. Thank you.